now, broadcasting from Titletown, USA, here's Joe Simon.
Hey, thank you for welcoming me into your place today. We're going to try to make this a quick and meaty discussion, as always, around the world in less than 60 minutes, hopefully a lot less than that. But the big question for you today is life insurance an investment, and are investments life insurance? Hopefully, as we walk through today's podcast, you'll get some new thoughts, some new questions, and some new answers to just that. We're talking all about the makings of life insurance and other things that you might be involved with today. But the big questions that we'll cover today are all around that. But first, let's start with some interesting statistics generated by LIMRA, who does a pulse of what's going on in the insurance industry and has for several years. But there are three big numbers they like to report that just came out in Q1 of 2025. 51% of Americans report having life insurance. 40% of Americans say, yeah, we have it, but we're not sure we have enough, probably need more. And the other one is 55% of U.S. workers say they are provided life insurance by their employer. Some say they don't quite understand how much, but they still say they know they have some. Question I would have with you on that is, how secure do you feel about having possibly all of your life insurance with just your employer? The follow-up question to that would be, are you planning on being with your employer for the rest of your life? Or the rest of your life where you come to the point where then you leave, but you're still in high standard as far as health insurability, and so you can flip to a personally owned life insurance policy, pass the underwriting, and nobody misses a beat. Something to think about as you, as workers in America, say, yeah, I've got my life insurance. Maybe the only amount I have is with my employer. And we know how people change jobs today. Something to think about there. But the three or four big questions I want to dig into today on that, this subject is, are life insurance premiums paid with after-tax dollars? They should be. In business cases, which we're not going to get into today, there are ways to pay with pre-tax dollars. But today's subject is all around personally owned life insurance. You use your debit card, your checkbook, you pay with after-tax dollars as the owner of that policy. You have chosen who the beneficiary is. What about the tax accumulation and the accumulation in the life insurance policy? Is that taxed? Is there capital gains on that permanent life insurance policy where you're putting money in and it's generating some form of accumulation? How about that? Is that taxable? And let me say, when borrowing accumulation in your life insurance policy that is a permanent policy that generates financial growth besides the death benefit, it can be tax-free if done the right way. Every circumstance is different and sometimes misunderstood, but the simple phraseology here is accumulation in the life insurance policy. Is it tax-free? It can be non-taxable, tax-free, if borrowed from the policy in the right way. We want to make sure we keep the policy alive to sort of not have to deal with something like that along the way. So what about the death benefit? I have $1 million death benefit life insurance policy, and my beneficiary is my spouse, my kids, my grandkids. I die. What happens to the death benefit? Remember, it's $1 million. Remember, you paid that with after-tax dollars. Remember, you're the owner and you've selected who the beneficiary is. What do you think? Is that death benefit? But it's $1 million. It's $1 million, but it's in that life insurance policy set up properly. The answer to that is yes. The rule is the death benefit is tax-free. So let's move on here. What I want to do is I've got an interesting illustration we can take a look at that really makes a comparison between the various types of investments people have. They consider, they match up against the life insurance. They say my investments are my life insurance policy. Here's a classic one. I have $1 million in my 401k plan. If I die, everybody's going to be taken care of. Absolutely. I agree. That's a lot of money. But is it tax-free? Remember, we just talked about a life insurance policy that's $1 million that goes to your loved one or loved ones. And it's what? Is it taxed or is it tax-free? It's tax-free. So let's look at this comparison. Going across the top in the blue bar, life insurance, non-qualified deferred annuities, Roth IRA, 401k, CDs, corporate bonds, U.S. government securities, and qualified traditional IRAs, and qualified retirement plans like your 401k, versus going down the far left-hand side, funding or contribution limits, tax-deferred accumulation, tax-free distribution, tax-free insurance death benefit, early withdrawal penalty taxes. What does that look like? So let's just compare the two farthest ones, the life insurance versus the qualified traditional IRA plan. What kind of limits, what kind of funding contribution limits are there? In the life insurance, there's none. You have to have the right size policy for the right size premium. But generally, they don't come in and say, well, you don't make enough money to put that amount of premium into that insurance policy. Qualified retirement plans and IRAs do say that. What about tax-deferred accumulation? Money into a permanent life insurance policy, growing nicely. Can you defer that? Absolutely. Same thing with the qualified traditional IRAs in your 401k, 403b, 401a. Tax-free distributions. Yes, there are tax-free distributions out of a life insurance policy. What about the qualified retirement side? Qualified traditional IRAs, qualified retirement plan like a 401k or 403b. Tax-free distributions? No, there aren't any. What about tax-free death benefit? Yes, the death benefit's tax-free under life insurance, under a qualified retirement plan, possibly if there's life insurance in there. Most policy plans, 401k plans, don't have that any longer. And what about the IRA? No, there's no tax-free insurance death benefit in there. Early withdrawal penalties, are they taxed? No. What about your qualified retirement plan? Early withdrawal penalties. Early withdrawal penalties mean 59 and a half or younger and you pull money out. Yes, there will be taxes on that. Well, what if you're 60 and you're still working and you pull out a third of what's in your 401k? Are there early withdrawal penalties? Generally speaking, no, not from a tax early withdrawal, not from a tax perspective, but there will be taxes. You must pay the Internal Revenue Service gatekeeper when you're pulling those dollars out of your qualified retirement plan. So, as we like to say, have a prosperous day. Keep thinking, keep stretching, keep looking for beneficial ways to have beneficial money. And we'll talk again soon. Thanks for joining us today.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. For more about Joe Simon, go to DaVinciInsurance.com. Joe Simon is a licensed insurance agent in the state of Wisconsin. Licensed to advise on accident and health, life insurance, disability insurance, and annuities, as well as qualified long-term care insurance. Make sure to visit the DaVinciInsurance.com archives for more of our podcasts.